Welcome to Money Law. I am Professor Coinstein. Today, we are traveling almost 2,000 years back in time to an empire that ruled the known world, printed its own currency, and, believe it or not, experienced one of the first economic bubbles in history. No, it was not about NFTs or crypto. It was about wine. Imagine Rome around the 1st century AD, the world superpower. 1 million people lived in the city alone, making it the largest metropolis on earth. Trade routes stretched from Britain to Egypt, from Spain to Syria. And into this network flowed a sea of one thing. Wine was not just a drink in Rome. It was a currency of pleasure, a sign of class, and a social lubricant that glued Roman culture together. By 100 AD, the average Roman citizen consumed between 180 and 250 litres of wine per year. That is roughly a bottle every single day. Yes, you heard that right. And they did not have Uber to get them home. The empire was obsessed. Every feast, every negotiation, every religious ritual, wine was there. It was poured, traded, even taxed. But behind this obsession, a market was growing. And like all markets driven by greed and hype, it was destined to explode. At the centre of this story were the great Roman vineyards. Names like Falernian, Cahacuban, and Massic. Falernian wine especially was the Bitcoin of its day, rare, prestigious, and absurdly expensive. Produced on the slopes of Mount Falernus near the Bay of Naples, it was said to age for up to 20 years and ignite when touched by fire, literally flammable due to its high alcohol content. The elite of Rome competed to own Falernian amphorae, those clay jars sealed with wax and marked with production years. Think of them as ancient NFTs with a cork. Pliny the Elder, a Roman author and scientist, wrote that a single amphora of top-quality Falernian could cost as much as 100 sesterces. Around a month's salary for a Roman legionary. But as the demand soared, so did speculation. Merchants began to hoard amphorae, betting that the price would rise. Wealthy senators invested in vineyards, not to drink the wine, but to sell it later at inflated prices. Even small traders joined in, forming something that looked suspiciously like an ancient version of Wall Street. It all started innocently, around 60 BC, as Rome expanded its borders, new territories poured in wealth and slaves, the backbone of agricultural production. Vineyards spread across Gaul, Hispania, and North Africa. Rome was swimming in wine. But the elite only wanted one thing, the prestige labels. Soon supply could not keep up with hype. Prices skyrocketed. Inscriptions found on amphorae show prices rising by as much as 300% over just a decade. Some vintages of Falernian were so rare that fake ones flooded the market. Ancient counterfeit wine, yes, that was a thing. Merchants reused old amphorae, stamped them with fake vineyard names, and sold cheap local wine as Falernian. The Roman poet Martial joked that his dinner guests were served Falernian. That tasted suspiciously like vinegar. Even back then, investors learned the same lesson as crypto traders today. When everyone is suddenly selling gold, it is probably not gold anymore. Meanwhile, the Roman Senate began to worry. Wine was becoming not just a drink, but a speculative asset. By the reign of Emperor Domitian, around 90 AD, the problem had grown huge. Wine was replacing grain fields, leading to food shortages. To stop the madness, Domitian issued an edict banning new vineyards in Italy and ordering half of all provincial vineyards to be destroyed. It was one of the first examples of a government trying to deflate an economic bubble. But just like modern markets, regulation came too late. The damage was done, vineyards had overexpanded, farmers were in debt, and prices began to fall. Suddenly, those who had invested their fortune in amphorae of Falernian or Cahacuban wine saw their value evaporate. The first Roman wine bubble had burst. The collapse rippled through the economy. Shipping companies lost contracts. Traders defaulted on loans. Roman bankers, called argentari, saw a wave of insolvencies. It is estimated that in the city of Pompeii alone, dozens of merchant houses went bankrupt between 60 and 80 AD. You can picture it, marble villas sold off, cellars full of unsold amphorae, and the ancient equivalent of traders screaming on the Roman forum floor. But the story did not end there. Like every bubble, it left behind innovation and change. The fall of the Italian vineyards opened opportunities in the provinces. Gaul, modern France, rose as the new wine superpower. Over the next 2 centuries, Gallic vineyards supplied much of Rome, Estimand laying the foundation for France. As wine dominance today, Historians estimate that by 300 AD, Gaul alone exported more than 100 million litres of wine annually to Rome and other provinces. The crisis had reshaped trade routes, redistributed wealth, and even changed European agriculture forever. So what made this all possible? The Romans had an incredibly advanced economic system. They had banking, credit, futures contracts, and something very close to corporate investment. Wealthy citizens would fund plantations through partnerships called societates, where investors pooled capital and shared profits. Sound familiar? It is basically venture capital in a toga. Add to that the massive scale of Roman logistics. More than 250,000 kilometres of roads, thousands of merchant ships, and standardised amphorae for storage, and you get a truly globalised wine market. But like all markets, it ran on emotion, greed, fear, and the eternal human belief that prices only go up. Now imagine a Roman dinner party in full swing. The host boasts that his Falernian amphorae is from the legendary vintage of 121 BC. Guests nod respectfully. Someone mentions the latest rumour that prices in the Forum Boreum, Rome, main wine market, have doubled in a month, another guest laughs, saying he is storing 500 amphorae in his cellar, waiting for next year. Spike, you can almost hear the ancient equivalent of "to the moon," echoing through the marble hall. The parallels to modern finance are almost too perfect. People thought they were investing in value. But what they really bought was belief, the belief that the crowd could not be wrong. The belief that someone else would pay more tomorrow. Even after the crash, wine kept its hold on Roman life. Writers like Juvenal mocked the rich for drowning their sorrows in luxury vintages, while the poor drank sour, watered-down wine called posca. The gap between classes grew, and just like in later bubbles, inequality fueled resentment. In a sense, the wine bubble became a symbol of Roman excess, a preview of the decadence that many historians believe weakened the empire from within. Overconsumption, speculation, and the obsession with luxury mirrored the decline of civic virtue that Roman moralists loved to complain about. Archaeologists have even found wine amphorae stacked in shipwrecks across the Mediterranean, proof of how far and wide this market reached. One famous wreck off the coast of France contained over 10,000 amphorae, enough to fill an Olympic swimming pool. It was basically a floating Costco for ancient booze. But let us be honest, the Romans were not stupid. They knew risk. The poet Horace famously advised, "Enjoy the moment, for tomorrow we may die." That might sound like YOLO investing, but it was also a warning. Fortune is fickle. Markets turn and bubbles burst. After the crash, Roman law slowly adapted. Contracts became stricter. Taxes on vineyards increased, and public granaries were expanded to ensure food security, because the empire had learned the hard way that you cannot drink your way out of a famine. Still, the pattern would repeat throughout history. The tulip mania in 1637, the South Sea bubble in 1720, the dot-com crash in 2000, all the same emotional story. Just different commodities. The Roman wine craze was simply the first time humanity tasted that intoxicating mix of profit and panic. And maybe that is the real lesson. Markets are not driven by logic. They are driven by people, the same people who cheered in the arenas, toasted to victory, and then cried into their empty amphorae when it all came crashing down. So next time you open a bottle of wine, think of the Romans, the empire that invented roads, concrete, plumbing, and possibly the first speculative bubble, because long before Reddit traders and Wall Street bets, there were toga-clad investors shouting across the forum promising each other that Falernian prices would never drop. Spoiler alert, they did. And in the ashes of that ancient bubble, the world learned something timeless. That greed ages faster than wine. So, what do you think? Would you have invested in Roman wine futures? Or would you have shorted Falernian like a cynical senator? Either way, remember, in the history of money, every glass comes with a warning label. Thank you for watching Money Law. I am Professor Coinstein, and this has been the first stock market bubble, the Roman wine craze.